Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today in the EIA show, we're going to look at the normal breakdown of what happened on a holistic level, looking at all the different pieces, and then going deeper into U.S. Demand for refined products. Where are we on the refining side? And then in the last segment, we're going to go more abroad and look at the global market and try to integrate all the different pieces. We always like to kind of look at what did we do, what did we get right, what did we get wrong. One of the bigger things that we got wrong was on the import side. So I was expecting to see a bit of an increase in imports into PADDIII. Instead, we got actually a big drop. And one of the things that I didn't appreciate was how big of a turnaround we're going to have essentially this week, next week, and then really starting to pick back up in the end of the week. In the end of the month. And that's really when you see that there was a decline of 685,000 barrels a day of throughput in PADDIII, which actually took us down on a utilization rate by 2.9%. So as those refiners went down, that increased underlying storage within PADDIII. And again, that was why we didn't see the same type of imports that I was expecting, because everything else was fairly stable. It's just PADDIII was the one that we missed on. In terms of U.S. exports, we were right there. We had that the big drop. We'll start to get a little bit of an increase. Then when we look at gasoline and diesel, or I should say distillate, when you look at some of the draws on the product level, a lot of that was driven based on the big decline in just refining utilization rates, especially in PADDIII, because as we go through in segment 2, you'll see that the biggest drop in storage happened in PADDIII, which obviously ties back to the reduction in refinery utilization rates, which means that they're going to run less crude, create less product, pull more from storage. So that's something that it normally happens, but it's just happening a bit later in the cycle, just because they were a bit more active, and then that will remain through through the rest of February, and start to come back in March. And again, those are things that we're going to talk about throughout segment 1 as well as segment 2. So when we look at on a global level, you can see total oil and products is just hugging the bottom of that cloud. The deficit widened from 94.1 to 102.4. And it was really driven by products. So one of the things that we've been talking about was how you'll get some of these lumpy moves coming from product storage, especially when we look at Singapore and when we look at Fujairah. So when you look at Europe has been fairly stable, something similar to the US of kind of this, more of a sideways move when you net everything out on that 4-week rolling average. But we had a sizable drop in Singapore and another one in Fujairah. And if you remember last week, we were talking about how ultra low sulfur diesel, very low sulfur diesel was starting to price itself out of the market. And there was a lot of available high sulfur fuel oil and residual fuel oil, and that started to see some movement. So again, there's just some timing delays in some of this. We will get a little bit of an increase this week into next. But again, that's where we saw some of the drop. So on the crude oil side, when you look at land and floating, the deficit narrowed from 38.8 to 37.4. But product stockpile was where we got the biggest increase, from the deficit widening from 55.4 million to 65 million. So when you look at the crude side, and that's when you look at land and floating, we're getting closer to that kind of that average range. It's on the product side that we continue to see some of that robust moves. And it's really because we are coming into that peak maintenance season in Europe, in the US, as well as some other areas, especially in Asia, i.e. China, which is again going to drop those stockpiles of product and start to increase some of those, some of the crude stockpiles, which we're going to talk about. Now, obviously, Russia is something that is going to continue to be a problem. Yesterday, they were going to pull back. Now, when you look at the data sets out there, they haven't pulled back. So you had crude going down 5. Now you have crude up 2.5. And again, there's just a lot of that geopolitical shifting back and forth. There's also what is happening in the physical market, because when you look at what has happened so far, so just to give you, and we'll go into more depth in segment 3, But Vital reduced its offer price for the third time this month for a cargo of Nigeria's crude for early March delivery. It's come down over $1 since that. And the problem is dated Brent. So when you look at Brent, and we'll look at time spreads, especially the Brent time spreads, which has exploded. And then when you look at the spread between Dubai and Brent at over $6, that's why you're starting to see some of the pressure in West Africa, and you're starting to see a pickup of some other purchases. And one of them at this point is the biggest issue in terms of where some of these differences are as the availability. Now, when we look at the different the different pieces. So Vital offered to sell 500,000 barrels of Nigerian crude at $4.40, more than dated Brent. So it keeps bouncing back and forth. It's still lower, but again, you're starting to see some of this coming back. And it's really because now as there's more concern about Urals, refiners are not buying Urals for fear of sanctions, which is going to put a bit more movement into West Africa, but we're going to talk about that a bit more. Now, the other component on the product side, so Nigeria received some gasoline that had way too much methanol in it, so a lot of it wasn't able to be used. So we're actually starting to see some pivots away from the U.S., away from some other areas, and they're going to redirect into Nigeria. So a tanker laden with European gasoline has switched destinations from New York to Nigeria. It has 37,000 tons of gasoline that was coming from Spain. So you're starting to see more of that getting siphoned into Nigeria to make up for some of these shortfalls. And that's something we're going to discuss more in segment 3. Now, when we look at land storage, this is just, again, looking specifically at what is happening on the land side. Here you can see that the deficit widened from 66.3 to 70.2. West of Suez, when you're looking at the U.S. and ARA, we went from a deficit widening of 52.3 to 60.4. That is going to start to close this week based on we had a build in Europe, we had a build in the U.S., so that will start to reverse. And then east of Suez, the deficit narrowed from 30.3 to 25.4. And just given the timing delay, that should widen back out, but there is still a lot of floating storage out there, and that's going to start to come on shore, especially as some of the teapots and the state-owned refiners in China start to get more active as they come out of their own maintenance season, which we're going to discuss in the last slide of segment 3. Now, the bigger issue before we get into floating storage is the massive spike in diesel prices. So diesel prices continue to strain governments as they're looking to stave off the inflation and rising energy costs. So you're starting to see a bigger push to make sure that they're, instead of having a mark to market against where crude prices currently are, they're trying to hold things firm. And just to give you an idea of what does that mean, well, in Thailand, they're saying that the government is saying that this week rejected a plea for an extra fuel subsidy, saying it would cost as much as $7.3 billion a year. So you're starting to see the pressure where some countries have to pass through some of the price because the subsidies just become too onerous on a government governments that are already strained from the fiscal and monetary stimulus that they put out during the COVID pandemic. So now when you look at floating storage here, so floating storage, the surplus narrowed from 43.1 to 41.8. And all of that was driven by west of Suez, because when you look at the U.S. pulled everything off of floating storage. Europe, the same thing. So you saw some of that go down. So when you look at the deficit narrowed from 5.8 to 4.1, and it's really because of West Africa, because the U.S. and Europe have been pulling in as much as they can off of floating storage, while West Africa still remains elevated. Now, east of Suez, the surplus widened from 45.3 to 46.2. Again, that's where you're starting to see some of those pressure points, and it remains on the east of Suez side where these additional cargoes are showing up, and again, moving into floating storage. Now, when you look at the U.S. stock, we had a small build of 1.12 million. That's still 68.2 million below the 5-year average. But look at PADDIII. PADDIII had a build of 4.16 million. And that's because of the drop in not only exports, but also the drop in run rates. And that's something that is going to persist over the next, let's call it 2 to 2.5 weeks, which is where you have almost 1.6 million barrels a day offline as they go through maintenance and their normal activity to keep things operational. When we look at PADDIII had another drop of 2.86 million, and then Cushing again had another drop of 1.9 million. So PADDIII overall 26.4 million below the 5-year average, Cushing 9.2 million below the 5-year average, which again remains in a place where we continue to see a drawdown on the Cushing front. When you factor in the SPR, as we've been talking about, there's a very steady drawdown that was already in place going out to 2027. So once you factor in the draws from SPR, we had a total net draw of 1.57 million. But again, what's going from SPR is going back into commercial storage and into the export market as well. So when we look at runs had a big drop of 2.9%. That pulled 676,000 barrels a day of throughput out of the market. And you can see that it was driven by PADDIII with the drop of 685,000. This should be the bottom. We were expecting a little bit of a staying up at that 87.5%. I underestimated how much maintenance was still left. I had thought some of that had come up, but Platts was correct, and they did have this coming through. So here we are. Now from here we should stay at this level, start to creep a bit higher. We had some capacity coming back in PADDIII of 154,000 barrels a day. And again, that's going to just be a slow grind back up, but we'll talk about that in the last slide of segment 1. Now, when we look at imports had a big drop of 598,000 barrels a day. That brings us about 1.3 million below the 5-year average. And you can see that it was driven by PADDIII, which had a drop of 431,000 barrels a day, which was 1.12 million below the 5-year average, just to give you an idea of how little is going into PADDIII at this point in time. PADDIII, a small drop of 56,000 barrels a day. That's something that we expect to reverse. And then PADDIII, we expected to see a little bit of a drop, but again, stay above that 5-year average. And that's going to continue to be a big driver of imports given where storage is and where their runs continue to sit. Now, on implied demand side, we got the drop that we were expecting in gasoline, a drop of 556,000 barrels a day. We should get a little bit more of a drop, something to about 8.3 million. But again, there's a lot of weather that's mixed into that, which again, just going to be a bit smaller of a drop. And then when we look at distillate, as we've been saying, distillate, we expect it to be strong. It's going to stay in this range. There should be a little bit of pressure on the heating oil side, as the weather has turned warmer, especially on large parts of the East Coast and the Midwest, which will help alleviate some of that heating oil demand, as well as propane. But then when you look onto the over to the West Coast, things get a bit colder. So natural gas should be a bit bearish, but a bit still a bit of a wash, just given where the cold is in the Midwest as well into the West Coast. So then when we look at propane continues to be robust, and we see that staying fairly elevated and strong into the remainder of the year at this point. So when we look at crude oil, excluding the SPR, you can see we're kind of sucking around right below the 2018 level. We do expect this to just creep back higher as some of the imports pick back up. But we had said that the last 2 weeks, but now that we have the maintenance season here, and realistically, we should start to see some increases. Now, there's going to be two pieces to that. One, exports were going to remain low just because of the cost versus where some of the other things are in the Middle East. But you're also going to have a little bit of pressure on the import side, because if you have crude in storage at these prices, are you really going to be looking to go out and pick up some of these very expensive cargoes, or are you going to try to live as much as you can within your storage levels, just because to try to make as much money and save as much money as possible? And these are going to be some of the key things that they're going to try to balance in order to keep some of the margins where they are. Now, when we look at what is happening on days of supply, So the days of supply came down a bit. That's going to reverse up this week, just given where some of the shifts are. We're right back to where we were in 2019 and 2020. And as we were saying, we expect that to go up, given the big drop in utilization rates and the increase in floating storage. The increase in storage. So now once you factor in commercial oil stocks, we had another small decline, getting us closer to that 2015 level that, again, traverses up. That's one thing where, typically we were expecting things to go a bit more sideways and actually start to trend up a bit. But the excessive drop in refinery run rates is going to keep crude going up. But depending on demand is going to kind of marry of how much is going to come out of storage. Now, that's going to be complicated even more by the fact that we're not going to be the best place to send gasoline. It's going to be Africa. It's going to be Nigeria. There's a panic there. There's long lines, there's big shortages. So there could be this big transfer. There's a lot of gasoline sitting in storage in Europe. So there's going to be a lot of pull coming from Europe into Nigeria, which could accelerate some of those pulls, especially because parts of Europe are also in maintenance season. So then when we look at what is happening on the gasoline storage side, we cross through where this 2018 level is. So you can see that there's typically that peaking here. It happened a bit earlier just because there's some of the drops. You can see there's normally some drops ahead, and then the drops typically happen, let's call it 2.5, 3 weeks earlier. But because maintenance season is happening now versus previous, you had some builds ahead of time. Now you're having some draws. So that just means that as we go through the next 4 weeks, we're gonna continue to move down. But then when things start to pick back up, that's going to push us closer to the top end of the range, but that's going to happen more in the middle of March versus a little bit earlier. So we're going to be in a bullish position, if you will, for the next few weeks, and then turn a bit more bearish as the comps get easier as we progress through the next 4 weeks. So then when we shift over and we look at, I just lost my spot. And then we look at distillate. So distillate is doing kind of what we were saying, where you were going to get, things were still going to draw, but it was going to be a bit more of a flatlining. And it was going to be, you can see how steep some of the rate of change is and how shallow it is. But then as we go through in segment 2, you're going to see that against that 29-year average, we're just following the rate of change. That's the average rate of change. So again, that's just going to keep us, in a bullish position given the backdrop, but again at the low end, but really not exceeding, but really kind of staying within this comfort zone as we do import more and exports still remain deeply depressed on the distillate side. Jet fuel is we will see this waffle around. There is going to be more of a move of jet fuel to the airports because there is going to be a buildup of storage for jet fuel, just given we're getting into the seasonal push as we go into winter break, spring break. That's when we start to see some of those increases, and that's going to be reflected in some of the demand numbers, which get a little bit more volatile given the rise in demand that will be coming. So when we look at the futures curve, you can see that there's been another big spike on the front months as backwardation just continues to extend. When you look at going through, essentially coming into the end of the beginning of 2023, we're above 80. And then really all throughout until 2025, we're above 70. And then you can see on the 65 line, we've had the curve shift even further up, again, keeping some of these projects well deep in the money when you look either onshore and offshore, just given where the current structure is. And again, the front months is being massively impacted by Russia, just given the avoidance of Urals, which is just looking at the floating market is almost 3 million barrels a day. So that's just on the floating market, not including what's going through the pipelines, to give you an idea of just the amount of crude that's going to have to be made up. So when you look at potential sanctions against Russia, we already have sanctions against Iran, we already have sanctions against Venezuela, you're getting an idea of just how we're missing a big piece of that heavy end barrel, which again is going to be a bit more of a problem, especially as we continue through the remainder of this year and beyond. When we look at COVID continues to cool off. You can look at the U.S. We're coming to the kind of this flatlining really worldwide as well. Europe, UK, India. Asia Pacific, even though India is coming down, still remains a bit elevated just because South Korea, Thailand continue to see an increase. Indonesia, something similar, where Japan is starting to come down. So really it's just timing. As we go through the next 2 weeks, you'll start to see Asia come down as well. But when you compare it on an activity level, the emerging market activity really hasn't been hit to the same way the developed market has based on this. But this is what we were expecting, where people are very much past COVID. Again, that's a personal thing as well as a national thing, because every nation's going to be slightly different. But you're just not seeing the same impacts in the emerging market world as we did on the developed side in conjunction with activity. So then when we take that and we look at PADDIII, things are moving up just based on how deep some of the refining utilization rates dropped. We should see another increase, in storage, which will take us right to the 2020 level. And PADDIII is going to continue to be where we see those builds as exports remain under pressure and more builds continue in that area. So then when we look at Cushing, another big drop. One of the things was we were expecting to see kind of this drop down and then this steady increase and come back to this 2018 level. Instead, we've continued to see these drops. At some point, we're going to be right if we say it enough times, as it seems, where we will start to get some of this turnaround as we have a bit more activity coming on the U.S. production side, and we see some of the pressure on exports and the drop down in activity in PADDIII, which should push back and keep some of this additional crude in Cushing. As we said before, floating storage came to zero. This should spike, but again, still just stay at the very, very low end of the floating storage cloud. This is where you can see what we were talking about. So we were expecting to see a bit more of a spike back up and get us closer into that lower end of the cloud. But instead, just based on when a lot of these facilities went down, instead it went the complete opposite way. We were expecting that there's a similar rate of change, but at the upper side. So instead we had that drop. We will get a bit of a recovery, but again, it's still just going to remain at the very, very low end of that cloud, especially as PADDIII remains in pretty steep turnaround. PADDIII, as we were saying before, is just going to stay at this right at the 6-year average. We included 2016. And it's just there's going to be a spike. It's going to stay well above the 5-year average. We're going to remain in this point, especially given where PADDIII storage is, where refinery run rates are, and PADDIII is going to keep imports coming down into that region. Now, when we look at utilization rates, you can see that we spiked a bit above that 29-year average and now right back below. Now, just given where we sit right now, it will stay fairly depressed or I should say just below that 29-year line into the end of February. And you can see that we normally kind of get that pivot point. Obviously, you had some of those extremes from weather, but that just gives you an idea of kind of where we start to see those increases, which is normally in the first week of March. Depending on how early maintenance season starts, it could be the last week of February, the first week of March. At this point, given where we sit right now, it'll likely be the first week of March into the second week of March that we start to see those increases. And again, getting prepared for summer driving season. Now, in the next segment, we're going to go deeper into what is happening with U.S. refined product demand and where do we see things going for the rest of the quarter.